Don't keep your cash in the bank. What if I told you that keeping cash in your bank account might be riskier than investing in something backed by the U.S. government itself? Yep. While your cash is silently losing value to inflation, there's a safer, smarter way to protect and grow your money, and most people have no clue about it. So let me ask you, have you ever looked at your bank account and realized that even though the number isn't going down, what you can buy with that money definitely is? That's because of one sneaky thing called inflation. Prices go up, but your cash stays the same. And while you're saving for that dream house or retirement, your money is quietly losing power. But here's the thing that wealthy people and smart investors know. Instead of just holding cash, they put their money into the following. Watch until the end, as we'll cover key benefits such as guaranteed growth, tax advantages, and the flexibility to access funds in case of an emergency. Let's get started. Number 1, Treasury bonds, government bonds. What are Treasury bonds? First things first, let's define what Treasury bonds are. Treasury bonds are long-term government debt securities issued by the U.S. government. When you buy one, you're essentially lending money to the government in exchange for a fixed interest rate, paid out over a set period, usually 10, 20, or 30 years. At the end of the bond's term, you get your initial investment or principal back. Why Treasury bonds are safer than cash? Well, the primary reason is that they are government-backed securities. These bonds are issued by the U.S. government, which is widely regarded as one of the most stable institutions in the world. They're backed by the full faith and credit of the U.S. government, which makes them virtually risk-free. Unlike cash, which can lose value due to inflation or other economic factors, Treasury bonds provide a guaranteed return, making them a more secure option. Another reason Treasury bonds are safer than cash is their consistent returns. Treasury bonds offer a fixed interest rate, which means you'll know exactly what your return will be over time. These bonds are considered a steady, reliable income source, especially in times of market volatility. While cash in a savings account might not generate significant returns, Treasury bonds provide a predictable income stream, making them a more attractive option for conservative investors seeking stability. But what about inflation? As you know, inflation erodes the purchasing power of cash over time. That's where Treasury inflation-protected securities, or TIPS, come in. TIPS are a specific type of Treasury bond designed to adjust with inflation. The principal value of these bonds increases with inflation, ensuring your investment keeps pace with rising costs. So, while cash might lose value when inflation rises, TIPS make sure your money grows to match inflation, giving you peace of mind that your investment maintains its real value. Let's take a look at some examples of Treasury bonds. The most common types include U.S. Treasury bonds, which can be bought in increments ranging from $100 to $1,000, and TIPS, or Treasury inflation-protected securities. Both of these types of bonds offer different benefits depending on your investment goals. Standard Treasury bonds are perfect for those who want a long-term reliable income stream, while TIPS are ideal if you're concerned about inflation. So why should you invest in Treasury bonds? First, they're backed by the U.S. government, making them a safe and reliable investment. Second, they offer consistent returns that are unaffected by market fluctuations. Finally, TIPS provide an inflation hedge, which is something cash can't offer. Whether you're a conservative investor looking for stability or someone who wants to protect their wealth from inflation, Treasury bonds are an excellent choice. How to buy Treasury bonds? Buying Treasury bonds is simple. You can purchase them directly from the U.S. government through treasurydirect.gov. The website offers an easy way to buy bonds in any denomination. And you can choose whether to invest in standard Treasury bonds or TIPS. You can also buy them through brokers or investment funds that specialize in government securities. Simply set up an account, choose your bond options, and you're good to go. So if you're looking to protect your wealth and get a steady return, Treasury bonds, especially TIPS, are a smart choice. Number 2, gold and other precious metals are safer, better than cash. People turn to precious metals as a shield against economic instability. But why exactly is that? Stay tuned as we break down how gold and other precious metals serve as a hedge against inflation and why they're considered one of the safest assets to hold. What makes precious metals safer than cash? First, Let's talk about why gold and other precious metals are safer than cash. Cash is subject to inflation. Simply put, inflation is the rate at which the general level of prices for goods and services rises, eroding the purchasing power of money. As inflation increases, the value of cash decreases. Gold, however, has an intrinsic value that doesn't fluctuate the way paper money does. For centuries, gold has been considered a store of value, and it's not tied to any government or currency. This means its value isn't directly impacted by things like inflation or currency devaluation. Hedge against inflation. Let's see how the concept of using precious metals as a hedge against inflation. In times of inflation, prices of everyday goods and services rise, but the value of gold has historically either stayed the same or even increased. This makes it an excellent hedge against inflation. Take, for example, the 1970s. Inflation in the U.S. surged, and the price of gold skyrocketed. More recently, after the 2008 financial crisis, when inflation was a concern, gold prices soared again. That's because, unlike cash, gold doesn't lose value when the economy goes south. Next, let's talk about the intrinsic value of precious metals. Intrinsic value means that the asset has inherent worth, regardless of external factors. In the case of gold, silver, platinum, and other precious metals, their value is not just a number on a piece of paper or an electronic transaction. These metals are tangible, they have physical properties, and they have been valuable for thousands of years. Gold, for instance, is rare. It takes a significant amount of energy and resources to mine, refine, and transport. Because of this rarity and demand, it maintains its value. Even if a paper currency crashes, you can still hold on to your gold, knowing it will have purchasing power. Precious metals are also considered safe haven assets. What does that mean? It means they tend to retain or even increase in value during times of economic crisis, political uncertainty, or market volatility. For example, during the 2008 global financial crisis, while stock markets were plummeting, gold prices surged. This is because investors flock to gold when they fear other assets are too risky, and during times of geopolitical uncertainty, like wars or political unrest, the demand for precious metals also increases. Different ways to invest in precious metals. Now, you might be wondering, how can I invest in precious metals? Well, there are several ways. You can buy physical gold and silver, whether that's in the form of coins, bars, or jewelry. This allows you to hold your wealth directly in your hands. However, if you don't want to store physical metal, you can invest in precious metals through exchange-traded funds or ETFs. These funds track the price of precious metals like gold, silver, or platinum, and allow you to buy shares without actually owning the physical metal. There are also mining stocks or other financial products tied to the price of precious metals. Each method has its pros and cons, but all offer exposure to the potential benefits of investing in precious metals. Number 3, precious metal ETFs, exchange-traded funds. Precious metal ETF is. ETFs, or exchange-traded funds, are investment funds that are traded on stock exchanges. A precious metal ETF is an ETF that tracks the price of a particular precious metal, such as gold, silver, or platinum. Instead of buying physical gold or silver, you can purchase shares in a precious metal ETF that reflect the price movements of those metals. One of the key advantages of precious metal ETFs is liquidity. Since they're traded on major stock exchanges, you can buy and sell shares easily, just like any other stock. There's no need to worry about finding a buyer for your gold bars or dealing with storage concerns. Whether you're buying or selling, the process is seamless and efficient. This makes them much more accessible and liquid compared to owning physical precious metals. Another big reason to consider precious metal ETFs is inflation protection. Historically, precious metals like gold and silver have been seen as a hedge against inflation. When inflation rises and the value of paper currencies declines, the price of gold tends to rise, helping you preserve your purchasing power. By investing in precious metal ETFs, you can gain exposure to this protection without needing to physically store large amounts of gold or silver. It's a simple way to safeguard your wealth from economic uncertainty. Precious metal ETFs are also known for their low fees compared to the costs of owning physical metals. Storing gold and silver can be expensive. Consider the cost of secure storage or insurance. But with ETFs, the management fees are typically low, making it a much more affordable way to gain exposure to precious metals. Moreover, these funds are considered a relatively safe investment. ETFs are highly regulated, so you know your money is being handled securely, with low risk compared to more volatile investment options. So, what are some popular precious metal ETFs? A couple of the most well-known are SPDR Gold Shares, ticker symbol GLD, and iShares Silver Trust, ticker SLV. These funds track the price of gold and silver, respectively, making them excellent options for investors looking to gain exposure to the precious metals market without the hassle of physical storage. Precious metal ETFs also offer a simple way to diversify your portfolio. Instead of holding large amounts of cash, which can be eroded by inflation, you can allocate a portion of your portfolio to precious metals through ETFs. This can provide balance and stability to your overall investment strategy. By including metals like gold and silver, you're adding another layer of protection against market volatility and economic downturns. Now, if you're wondering how to buy precious metal ETFs, the process is straightforward. You can buy them through most online brokerage platforms, just like you would any other stock or ETF. All you need to do is log into your brokerage account, search for the ETF ticker symbol, GLD for gold or SLV for silver, and place an order. It's that simple. Compared to owning physical gold or silver, precious metal ETFs offer several advantages: no storage or insurance costs, lower fees, and the convenience of trading them on stock exchanges with high liquidity. You avoid the logistical headaches of dealing with physical assets, no need to store them securely or worry about theft. You also have the flexibility to trade quickly whenever you need to. So why should you consider precious metal ETFs? They offer liquidity, inflation protection, low fees, and a safe investment option to diversify your portfolio. These benefits make them an excellent alternative to holding cash, especially during times of economic uncertainty. Before we continue, I have a free investing guide just for you. I've created a free guide called Top 5 High-Interest Investments for Maximum Compounding. Inside, you'll learn the best investment strategies used by top investors to multiply their money faster. Click the link in the description to download. So let's proceed to Number 4, real estate safer than cash. First, let's talk about what makes real estate safer than cash. Cash is a digital or paper asset, and it can be devalued or affected by inflation, currency fluctuations, and other economic factors. Real estate, on the other hand, is a physical, tangible asset. It's something you can see and touch, which gives it inherent value that doesn't depend on the whims of the financial markets. Unlike cash or digital currencies, real estate is a hard asset. It's not vulnerable to the same risks of devaluation that affect currencies, meaning it holds its value much more reliably over time. One of the biggest reasons real estate is considered a safe investment is because it generally appreciates over time. Real estate doesn't just sit there, it increases in value. Whether you're holding on to a residential home or a commercial property, the value typically goes up over the years. But it doesn't stop there. Real estate can also generate steady cash flow through rental income. Whether it's a single-family home, apartment complex, or commercial property, rental income can provide a reliable source of revenue, unlike the interest you get from leaving cash in a bank account. Real estate is also a powerful hedge against inflation. As inflation increases, the value of money decreases. But real estate values tend to rise with inflation, meaning your property's value and your rental income can increase in line with the cost of living. During periods of inflation, the price of goods and services rises, but properties typically see an increase in value, making them an excellent tool to preserve and grow wealth in uncertain economic times. Now, let's look at different ways you can invest in real estate. The most obvious method is buying residential properties, whether it's a single-family home or a multifamily property. These can provide both appreciation and rental income. Then there are commercial properties like office buildings, retail spaces, and warehouses. These can provide higher rental income and sometimes greater returns, depending on the location and demand. And for those who prefer a more hands-off approach, real estate investment trusts, or REITs, are an excellent option. REITs allow you to invest in real estate without directly owning property. These funds pool investors' money to buy, manage, and sell real estate. You can invest in a wide variety of properties from shopping malls to hospitals and receive income from rental earnings and property appreciation. Real estate is a safer investment than cash because it's a tangible asset, provides appreciation over time, generates income, and acts as a hedge against inflation. Number 5, dividend-paying stocks, blue chip stocks. What are dividend-paying stocks? These are shares in companies that pay out a portion of their profits to shareholders on a regular basis, typically quarterly. This payment is called a dividend, and it serves as a source of consistent income. The companies that pay dividends are usually well-established, financially stable, and have a track record of profitability. Unlike cash, which just sits there, earning little to no interest, dividend stocks provide regular income. And the best part? You can reinvest these dividends to compound your returns over time. The more you reinvest, the more shares you own, and the more dividends you can earn in the future. One of the main reasons dividend-paying stocks are safer than cash is because they generate income. Let's compare. Cash sitting in a bank earns very little in interest, while dividend stocks provide regular payouts. These payouts can be reinvested, helping you grow your portfolio exponentially over time. For example, if you invest in a company like Coca-Cola, not only do you receive regular dividend payments, but you can also use those dividends to purchase more shares. Over time, this reinvestment strategy can significantly boost your portfolio's value. Another reason why dividend-paying stocks are safer than cash is long-term growth. Companies that pay dividends, especially blue-chip stocks, tend to appreciate over time. Blue-chip stocks are shares in large, stable, and well-established companies that have weathered many economic storms and continue to grow. Think about companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble. These companies have proven their ability to deliver long-term growth. And not only do they offer stability, but they also increase in value over time, making them a solid investment choice for growing your wealth. Dividend stocks also serve as a hedge against inflation. As inflation rises, the value of cash declines, but equities like blue-chip stocks tend to grow over time, often outpacing inflation. This makes dividend stocks a great way to protect the value of your money, especially when inflation is high. Cash, on the other hand, loses value over time due to inflation, which is why dividend-paying stocks are a much safer bet. Companies like McDonald's, Coca-Cola, and Johnson & Johnson have consistently raised their dividends even during tough economic times, which means their value continues to grow while cash loses purchasing power. Let's talk about a specific group of dividend-paying stocks known as dividend aristocrats. These are companies that have not only paid dividends consistently for decades, but they've also increased their dividend payouts for at least 25 consecutive years. That's a track record of stability and reliability. Examples of dividend aristocrats include Coca-Cola, McDonald's, and Johnson & Johnson, companies that have demonstrated an unwavering commitment to paying and increasing dividends year after year. If you're looking for stable, income-producing investments, dividend aristocrats are the way to go. Dividend-paying stocks are a safer investment than cash because they provide consistent income, long-term growth, and protection against inflation. Blue-chip stocks, especially dividend aristocrats, are some of the most reliable investments you can make. Number 6, short-term certificates of deposit, CDs. Why they're a safer and smarter choice than holding cash in a regular savings account. If you're looking for a low-risk investment with fixed returns, CDs might be the perfect option for you. Let's start by explaining what a certificate of deposit or CD actually is. A CD is a low-risk, government-backed savings product offered by banks. When you invest in a CD, you're essentially lending your money to the bank for a set period of time, typically ranging from a few months to a few years in exchange for a fixed interest rate. Unlike cash sitting in a regular savings account, CDs offer you a better return, especially when you lock in a higher interest rate for longer terms. While you won't have immediate access to your funds with a CD, it's a way to earn more than what you'd get from just holding cash in a savings account. One of the biggest reasons why short-term CDs are safer than cash is because they offer low risk and fixed returns. Since CDs are backed by the government through FDIC insurance, you know your money is safe, just like it would be in a savings account. The difference is that with a CD, your returns are fixed, so you can plan for how much you'll earn during the term of the deposit. With cash in a savings account, the interest rates are typically much lower, and they can fluctuate. But with a CD, you're guaranteed a fixed interest rate for the duration of your term, which means you know exactly how much you'll earn at the end. While you won't have immediate access to your funds with a CD, it's still a very safe investment. Most importantly, your money is FDIC insured, which means that if the bank were to fail, your investment is protected up to the allowable limit. This makes CDs a safe and secure option, similar to keeping cash in a savings account but with better returns. Yes, you'll need to wait until the CD matures to access your money, but this trade-off usually results in higher returns compared to keeping your money in a regular savings account. It's like getting paid to be patient. Another key factor that makes short-term CDs safer than cash is the FDIC insurance. Just like the money in your savings account, CDs are insured by the Federal Deposit Insurance Corporation, or FDIC, up to the allowable limits. This gives you peace of mind knowing that your money is protected even if something unexpected were to happen with the bank. The FDIC insurance guarantees that your investment is safe, so even if the bank were to face trouble, your funds would still be secure. This makes CDs a very safe and stable choice for conservative investors. So, what do short-term CDs actually look like in practice? Well, many banks offer competitive interest rates on short-term CDs, with terms ranging from just a few months to a year or two. The interest rates on these short-term CDs tend to be higher than those on regular savings accounts, especially if you lock in a rate for a longer term. For example, you might find short-term CDs with interest rates in the 3 to 5% range, depending on the bank and the term. Of course, the longer you commit to keeping your money in the CD, the higher the interest rate you may be able to secure. Number 7, municipal bonds, muni bonds. What are municipal bonds? Municipal bonds, or muni bonds, are debt securities issued by local governments, like states, cities, or counties, to fund public projects such as building schools, bridges, or hospitals. When you invest in muni bonds, you're essentially lending money to a local government for a set period in exchange for periodic interest payments and the return of your principal when the bond matures. One of the biggest reasons municipal bonds are safer than cash is their tax advantages. The interest you earn on muni bonds is exempt from federal taxes, and in some cases it's also exempt from state and local taxes, especially if you live in the state where the bond was issued. This means more of your investment income stays in your pocket, which can make muni bonds a more efficient investment compared to other bonds or cash that are subject to taxes. Muni bonds also provide steady returns, which can be much safer and more predictable than cash. While the returns might not be as high as some riskier investments, they're generally stable, offering a reliable income stream. Unlike cash in a savings account, which barely earns any interest, muni bonds provide predictable interest payments often twice a year. So not only are they safe, but they offer steady income over time. Municipal bonds are considered low risk, especially when issued by municipalities with high credit ratings. The risk of default is relatively low, particularly for general obligation bonds, which are backed by the taxing power of the local government. While no investment is completely risk-free, the chance of a local government defaulting on its debt is very low, particularly if the bonds come from stable, high credit-rated regions. Number 8. High-yield savings accounts and money market accounts. What are high-yield savings accounts and money market accounts? Simply put, these are types of deposit accounts offered by banks or credit unions that provide higher interest rates compared to regular savings accounts. While both accounts allow you to deposit money, earn interest, and access your funds, high-yield savings accounts and money market accounts usually offer significantly better returns, giving your money a chance to grow faster than it would in a traditional savings account. Now, you may be asking, why are these accounts safer than cash? The key reason is that both high-yield savings and money market accounts are insured, meaning your money is safe, just like it would be in a regular savings account. These accounts are insured by the FDIC for banks or NCUA for credit unions, offering the same level of safety as a traditional savings account. This means that even if the financial institution were to fail, your funds are protected up to $250,000 per depositor per insured bank or credit union. This level of protection is a major reason why high-yield savings and money market accounts are considered safer than cash, sitting in a drawer, or even in some investments that aren't insured. Another reason these accounts are safer than cash is the higher interest rates they offer. With a regular savings account, your cash is earning minimal interest, often less than 1%. In contrast, high-yield savings and money market accounts can offer interest rates from 3% to 4% or even higher, depending on the bank or credit union. While these interest rates may not seem huge over time, they can add up significantly. You're earning more than cash sitting idle, and the best part is your money stays liquid and accessible. One of the biggest advantages of high-yield savings and money market accounts is liquidity. This means you can easily access your funds whenever you need them, unlike other investment options that may require you to lock up your money for a certain period. You don't have to worry about penalties for early withdrawal, and you can transfer or withdraw your funds at any time, making these accounts incredibly flexible. Let's talk briefly about the differences between high-yield savings accounts and money market accounts. While both offer higher interest rates, money market accounts typically require a higher minimum balance to open, and they often come with features like check writing or debit card access. High-yield savings accounts are usually more accessible with lower minimum balances and are simpler to manage, making them perfect for savers who want to grow their money without having to manage extra features. Now that you know why these accounts are safer than cash, let's look at how to find the best options. You can easily compare high-yield savings and money market accounts online. Look for accounts with competitive interest rates, no monthly fees, and easy access to your funds. Online banks and credit unions tend to offer the highest rates, so they're often your best bet for finding a solid account that will grow your savings safely. Finally, number 9, cash value life insurance, whole life or universal life. Let's start with the basics. Cash value life insurance, including whole life and universal life, is more than just a life insurance policy. In addition to providing a death benefit, it accumulates cash value over time. This cash value grows within the policy and can be accessed during your lifetime for things like loans or withdrawals. One of the key benefits of cash value life insurance is the stable growth. Whole life insurance policies, for instance, guarantee a certain growth rate of your cash value. That means, unlike cash in a savings account, your money is growing consistently and predictably. And because it also includes a death benefit, you're getting dual protection. Your family is taken care of, and your savings are steadily growing. When it comes to safety, cash value life insurance shines. The cash value grows at a guaranteed rate, which is far safer than leaving your cash in a savings account or hiding it under your mattress. Life insurance offers you peace of mind with predictable growth. Another benefit of cash value life insurance is the tax advantages. The cash value within these policies grows tax deferred, meaning you don't have to pay taxes on the growth until you access the funds. This means more of your money stays working for you, compounding and growing until you need it. One of the most powerful aspects of cash value life insurance is that you can borrow against the accumulated cash value. Need money for an emergency, a large purchase, or an investment opportunity? You can access your cash value through loans with typically lower interest rates. And the best part? There's no lengthy approval process like you'd have with a bank loan. You're borrowing from yourself, and you have the flexibility to repay on your own terms. Cash value life insurance provides a safety net in emergencies. Life is unpredictable, and when unexpected expenses arise, you may need quick access to funds. Having a cash value policy allows you to tap into your savings, giving you peace of mind knowing you have backup funds available. So, who offers these types of policies? Some of the most trusted names in the life insurance industry are companies like Mass Mutual, Northwestern Mutual, and New York Life. These companies have long histories of offering stable, reliable life insurance policies with strong growth potential. Now let's see the difference between whole life and universal life insurance. While both types of policies build cash value, whole life offers fixed premiums and guaranteed growth, while universal life allows more flexibility. You can adjust the premiums and death benefit, and the growth rate can vary depending on the market. Whole life is more predictable and consistent, while universal life offers greater flexibility, but with some variability in growth. To wrap it up, cash value life insurance, whether whole life or universal life, provides a combination of growth, protection, and flexibility that makes it a smart choice for anyone looking to secure their financial future. It's safer than just holding cash, offering guaranteed growth, tax advantages, and access to funds when you need them. If you're ready to start exploring life insurance as part of your financial plan, make sure to do your research and find a policy that works best for you. Thanks for watching. If you found this video helpful, be sure to like, share, and subscribe for more investment insights. If you have any questions or thoughts, drop them in the comments below. Remember to download my free guide, Top 5 High-Interest Investments for Maximum Compounding, link in the description. And see you in the next video.